Welcome, dear traders. I don't think it's likely the committee will reach a level of confidence by the time of a March meeting to ease policy, Fed head Jerome Powell said yesterday at a news conference. But that's to be seen, he added, dropping a long-standing reference to possible further hikes in the borrowing costs. We are talking about a possible rate hike. The Fed is not considering that at the moment. On the contrary, the market pushed the cart before the horse. It's already pricing into stock and currency index prices decisions by regulators that are still months away. The Fed rate forecast tracked by the FEDWATCH tool clearly shows this trend. For example, in December 2023, 80% of the market anticipated a rate cut in March. Yesterday, this figure was around 45%, and this morning it has fallen to 35.5%. Nevertheless, the market still believes that the US regulator will reduce the interest rate by 150 basis points this year. The Fed's silence has left room for traders to make their own predictions about the timing of the first rate cut. Meanwhile, the US dollar continues to benefit from this delay. On the other hand, the expectation of a possible rate cut later this year may eventually undermine the US dollar. The market, as well as the Federal Reserve itself, fears that inflation will prove too stubborn to be contained. That's the so-called last mile will take a long time, and the regulator will eventually take too long to cut the rate or decrease it to a lower level than planned. Yesterday, the Federal Reserve again kept its interest rate at a 23-year high of 5.2 and 5.5%. At the same time, the regulator said in its summary that the risks to meeting both the employment and inflation goals are moving into better balance. However, the US dollar experienced a kind of a turbulence yesterday, and the greenback plunged to 103.10 and then jumped to 103.60. The US currencies rally began after Jerome Powell's words that a March rate cut was not the base case. In the early Thursday trading, the US dollar continued its rally and even climbed above its 7-week highs to 103.70. And the markets are awaiting reports on the US nonfarm productivity and unemployment, which will be released today. However, the US dollar index is strengthening against most of its major counterparts. Bulls continue to push its price higher within the range of 103.40 and 103.60. On the daily time frame, the next support and resistance levels are at 103.00 and 103.80 respectively. However, the unquestioned dominance of the US dollar in its currency basket still has a weakness. The Japanese yen has more and more opportunities to compete with the US currency. And first of all, the outlook of the Bank of Japan is becoming more hawkish against the backdrop of the future reversal of the US Federal Reserve policy. The yen also benefited from the news today. In the United States, shares of a New York Community Bank Incorporated plummeted by a record 46% after reporting unexpected losses, and this may be the beginning of a banking crisis, and the lender's problems have alarmed investors and led to an outflow of assets, including into the safe haven yen. In Japan, there was a no less significant event for the country's current today. The financial fraud scandal that began in December has reached its conclusion. The largest faction of the ruling Liberal Democratic Party of Japan has adjusted the accounts of its fund. In addition, 4 of the party's 6 government factions are being dissolved. From the 2 remaining factions, lawmakers have begun to resign. Following the investigation, 10 of the 15 senior government officials resigned from their posts. All of them had supported the so-called Abenomics policies, and their departure means more leeway for the Bank of Japan to make financial decisions. As a result, the yen is attracting buyers to the second day in a row, and the currency is trading in the 146.40 and 147.10 range against the US dollar in Asian trading. In addition, the decline in the US Treasury yields is causing dollar bulls to take a defensive position and provide additional support to the yen. Early Thursday, the dollar-yen pair went into consolidation in anticipation of a new data on the US economy, and they held below the psychological level of 147. Strong reports will help the US dollar recover against the yen and may lift the pair to the resistance area of 147.20 and 147.80. Most likely, bulls will try to wait for the further buying above the 148. The pair may even hit the 2-month high reached in January. In the meantime, the pair is showing bearish momentum. A bearish move could further push the Japanese currency in the range of 146.20 and 146.50. After Jerome Powell's relatively hawkish comments on the US interest rates and the unexpectedly weak quarterly inflation report in Australia, the country's currency is unable to resist the greenback. Against the backdrop of all the downward factors, the Aussie began to fall. By the end of the Asian session, it was already trading near 0.6520. However, the Aussie has been trying to consolidate and has even tried to grow toward the upper boundary of the 0.6510 and 0.6580 range. As the low inflation data cancels the possibility of an interest rate hike by the Reserve Bank of Australia, and the Aussie is in a weak position against the US dollar. Today, even positive news from China failed to inspire bulls of the Aussie dollar pair. Therefore, the most realistic option for the Aussie today is to move towards the 0.65 mark and the technical support level of 0.6460. If the pair breaches the 0.65 level, it may find a resistance level of 0.6610, and the New Zealand dollar has already breached the key level of 0.61 in early Monday trading. Now, it's trading lower within the range of 0.6090 and 0.6140. The key technical support and resistance levels are at 0.6060 and 0.6150 respectively. That's all for now. Stay tuned for more updates with the InstaForex TV. We appreciate your feedback. Please leave your questions and comments below, and see you online soon.